Empires don't collapse in fire. They collapse in trust. And trust doesn't vanish with noise, it vanishes with silence. One day you wake up, and the number you thought was yours is just a number someone else allowed you to see. Your balance becomes a permission slip. Your savings, a liability on someone else's book. The money you believed was yours was never truly yours. It was theirs all along. This is how it always begins. Quietly, without sirens. Because when the end comes for a financial empire, it never begins with panic on the streets. It begins with signatures in marble rooms where the laws of ownership are quietly rewritten. The ancients would have called it tribute. The medievals called it tithes. We call it policy. But it's all the same thing, a system that feeds on confidence until confidence dies. Every civilization that ever reached for greatness has followed the same script. First, the creation of a symbol of value. Then the corruption of that symbol. And finally, the confiscation of whatever remains. Historians have a phrase for this recurring phenomenon. Economists prefer softer words like devaluation or liquidity event, but in truth, it is none of those things. It is something far older and far simpler, the moment when rulers, bankrupt from their own excess, turn to their people's wealth as the final harvest. It is the banking seizure pattern. You can see it etched into the bones of history. Pattern 1. The Roman confiscations. In the 3rd century, Rome was broke. Centuries of conquest had turned into centuries of administration, and administration is expensive. Emperors needed coin, and coin required silver. But silver was scarce, and taxes were exhausted. So they did what every desperate government eventually does. They redefined the meaning of value. Rome's silver denarius, once a trusted symbol of the empire's might, was melted down, diluted, and stamped anew, a coin of promises instead of metal. Citizens watched their savings dissolve, not in war, but in decrees. When that wasn't enough, the state began to seize property outright. The wealthy were branded as hoarders, their estates confiscated for the good of the empire. The pattern was set, legal seizure wrapped in moral justification. By the time Diocletian issued his infamous edict on maximum prices, money had lost all meaning. Barter returned. Soldiers were paid in grain. The empire that once built roads across continents couldn't pay to pave its own. And still, no one called it theft. They called it policy. Pattern 2, the Spanish bankruptcies. 1,000 years later, Spain ruled half the world. Gold from the New World flowed endlessly into its coffers. But empire breeds arrogance, and arrogance breeds debt. By the 16th century, Spain's kings were addicted to borrowing, financing wars they could no longer afford. The bankers of Genoa, Antwerp, and Augsburg held the kingdom's fate in their ledgers. When the gold ships sank or the wars went badly, the crown defaulted. And each time, the king declared a restructuring. Assets were seized, interest payments frozen, and the lenders, many of them Spanish merchants and nobles, were ruined. It was the first modern bail-in. The wealth of private citizens was legally absorbed to protect the illusion of solvency. Spain's power, once backed by treasure fleets, dissolved into insolvency disguised as policy. And as faith in the crown's credit vanished, so too did the empire's light. Pattern 3, the British Bank Moratorium. Fast forward to 1914, the British Empire ruled the seas. The pound sterling reigned supreme, and London was the beating heart of global finance. But the shadow of war crept across Europe. In the days before World War I erupted, British citizens lined up outside their banks. Rumors spread that the gold standard would be suspended. The government faced a choice: admit insolvency or rewrite the rules. So it did what all empires eventually do. It declared a bank holiday. For 4 days, withdrawals were frozen. Citizens couldn't touch their own deposits. The Bank of England printed emergency notes. Parliament passed the Moratorium Act, effectively saying, "Your gold is ours, for now, for your own good." The justification was noble to save the banking system, but the message was clear. In times of crisis, ownership is suspended. When the war ended, the people had grown used to the illusion of paper money. The trust, once broken, was replaced by compliance. The empire survived a little longer, but the pound's supremacy never truly recovered. If you trace these stories across time, you'll find one unbroken thread. When governments run out of money, they reach for yours. They call it patriotic. They call it temporary. They call it necessary to stabilize the system. But history calls it what it truly is: confiscation dressed as salvation. The modern world likes to imagine that it has evolved beyond such crude tactics. We speak of deposits, insurance, liquidity facilities. We believe that laws protect us from the predations of our own financial institutions. Yet the very laws we trust are now written by the same hands that will one day close the vaults. In 2013, the tiny island of Cyprus gave the world a preview. Banks collapsed after years of reckless lending. But instead of using taxpayer money to bail them out, the European Union approved a new solution. Bail-in's depositors themselves would fund the rescue. Accounts above €100,000 were frozen. Up to 60% of their savings were converted into bank shares, worthless paper in exchange for hard-earned deposits. Overnight, millions learned that their bank balance was not a promise, it was a claim, subject to approval. The precedent was set, and quietly, nations around the world took notes. Today, almost every major economy from the United States to the European Union, from Canada to Australia, has quietly written bail-in clauses into their banking regulations. Under these laws, when a bank faces insolvency, it no longer turns to taxpayers, it turns to depositors. The money in your account, legally, belongs to the bank. You are a creditor, not an owner. And in times of systemic risk, those funds can be restructured into equity. It's a stunning act of linguistic sorcery. Seizure becomes stabilization, theft becomes resolution. But the outcome is the same as Rome, as Spain, as Britain. The public pays for the sins of the powerful. The irony, of course, is that most people won't believe it until it happens. They will say, that could never happen here. They will trust their statements, their apps, their cards. They will believe that digital numbers equal ownership. Until one morning, they don't. The silence of a frozen ATM is no different from the silence of an empty vault. The banking seizure pattern follows 5 immutable stages. Stage 1, expansion. The empire grows fat on credit and faith. Banks multiply, speculation rises, and prosperity feels permanent. Stage 2, excess. The system becomes addicted to leverage. Debt piles up, but the illusion of growth masks the rot beneath. Stage 3, denial. Warning signs emerge. Bank failures, liquidity crises, whispers of reform. Leaders reassure the public that everything is fine. Stage 4, seizure. The laws change quietly. Withdrawals are limited, assets frozen, temporary controls imposed. The people are told it's for their protection. Stage 5, submission. Trust dies. The people accept new rules of ownership. The old world ends not with rebellion, but resignation. We are standing between Stage 3 and Stage 4 now. The warnings are everywhere. The liquidity crunches of 2023. The regional bank collapses. The quiet centralization of digital control under the banner of safety. But few see the pattern for what it is. When money becomes faith and faith becomes regulation, you no longer have currency, you have obedience. There's a line carved deep into every empire's tombstone. We thought we were different. Rome thought so, Spain thought so, Britain thought so. And now America believes the same. But history has no favorites, only patterns. When the final cycle turns, when the vaults lock and the screens freeze, it will not be called a theft. It will be called a plan, the 2025 bail-in plan. When money loses meaning, what replaces it? Silence, control, and the illusion of safety. And so, as we approach another turning of the financial wheel, remember, the laws of empire never change, only the methods do. The next seizure will not be physical. It will be digital. And this time, you will not see the vault close. You will see your balance change. History has never repeated itself perfectly. It echoes soft at first, then louder until the sound becomes a roar. Every financial empire thinks it has discovered a new way to cheat gravity. Each builds taller towers of trust, forgetting that the weight of belief has always been the heaviest currency of all. The banking seizure pattern didn't die with Rome or Britain. It only changed its costume from marble halls and silver coins to skyscrapers and digital ledgers. And in those reflections, we begin to see the next act of the play unfolding. In the winter of 1933, panic spread like a fever across the United States. Banks had fallen like dominoes after the crash of '29. Families who had spent a lifetime saving now waited in endless lines outside shuttered doors. The nation that had invented modern capitalism was being devoured by its own creation. Then came March 6, 1933, the first national bank holiday. Franklin D. Roosevelt, newly inaugurated, declared that all banks would close for 4 days. Withdrawals were suspended. Access to deposits frozen. It was sold as a measure of confidence, but for millions, it felt like confiscation. The same fear that gripped Rome's citizens under Diocletian, that their stored value had vanished, was reborn in the modern age. When the banks reopened, the rules had changed. The government now required all private citizens to hand over their gold coins and bullion in exchange for paper dollars. Executive Order 6102 made it illegal to hoard gold, a word that disguised obedience as virtue. Americans who refused faced imprisonment. Those who complied saw their gold confiscated at $20.67 an ounce. Months later, the government revalued it to $35, a 69% devaluation of savings overnight. Legally justified, publicly rationalized, morally disguised, the state had performed a perfect sleight of hand, a bail-in by any other name, the wealth of the public absorbed into the bloodstream of the system. Nearly 70 years later, on the other side of the world, Argentina followed the same path. After decades of inflation, debt, and IMF restructuring, the nation reached the breaking point. The peso was collapsing, foreign reserves were gone, and confidence was evaporating. So, in December 2001, the government announced the corralito, the little corral, a poetic word for a prison made of policy. Citizens could withdraw no more than 250 pesos a week. Accounts were frozen, businesses starved. Riots erupted in Buenos Aires. The government fell. When the freeze lifted, people discovered that their dollar-denominated accounts had been forcibly converted into pesos at a rate set by the state. Their life savings erased by decree. Banks didn't steal the money, they simply changed its meaning. This was the new seizure, not through soldiers or raids, but through spreadsheets and signatures. The pattern had evolved, confiscation had gone digital. By 2015, Greece had become the pariah of Europe. Crushed under a mountain of debt, it faced the same question every dying empire confronts: who will pay the price? The European Central Bank answered it for them. When Greek banks ran out of liquidity, the government imposed capital controls. ATMs were limited to 60 euros per day. Businesses couldn't transfer funds abroad. The people watched helplessly as their digital balances became abstract art, visible but unreachable. In the end, the banks reopened under a new deal. Depositors would bear part of the losses. The term bail-in entered the European vocabulary. It meant that if the banks failed, the people would pay, just as they had in Cyprus. Just as they will again, it wasn't just a financial failure, it was a psychological one. Greeks began to understand what Romans, Spaniards, and Americans once learned, that the system doesn't collapse when the money runs out. It collapses when belief does. In every case, the sequence is nearly identical. Expansion through credit, prosperity built on borrowed time. Crisis through excess leverage reaches its breaking point. Fear and paralysis citizens rush to withdraw, and the state steps in to protect stability. Legal seizure assets, frozen, converted, or restructured. Normalization, life goes on. But the definition of ownership has changed forever. Each time the language grows gentler, temporary controls, emergency measures, financial hygiene, but the reality remains brutal. Private wealth becomes public collateral, and each time humanity convinces itself that this version is different. If you study the U.S. legal framework since the 2008 financial crisis, you will find the ghost of Cyprus buried in the fine print. In 2010, the Dodd-Frank Act abolished taxpayer-funded bailouts. It sounded noble. The people would never again rescue reckless banks. But the act also created something new: the orderly liquidation. Authority. This authority gives regulators the power to seize failing banks and convert certain liabilities, including uninsured deposits, into equity to stabilize the system. In other words, your money becomes their balance sheet. By 2017, the Federal Deposit Insurance Corporation, FDIC, and the Bank of England issued a joint paper outlining how large cross-border banks could execute bail-in resolutions. The document was bureaucratic, dense, and almost unreadable, but its conclusion was chilling. Depositor funds could be used to recapitalize failing institutions, provided it was done in an orderly manner. The phrase orderly manner is the modern euphemism for controlled confiscation. And in 2025, That plan, updated, digitized, and wrapped in stability rhetoric, is quietly being prepared for activation. Central bank digital currencies, CBDCs, are being sold as progress. Fast transactions, programmable payments, financial inclusion. But history tells us that every innovation in money eventually becomes an instrument of power. Once money is programmable, ownership becomes permission-based. Funds can be frozen, redirected, taxed, or limited to specific uses with the stroke of a key. The digital vault becomes the perfect instrument of the banking seizure pattern: invisible, instant, and irreversible. And when combined with modern bail-in laws, it creates the perfect trap, not a corralito of metal bars, but one of code. When your savings exist as numbers on a central ledger, seizure requires no physical act, only a policy update. The brilliance of the banking seizure pattern lies not in its legality, but in its psychology. People do not rebel against what they do not understand. If you raid a man's home, he will fight. If you rewrite his bank balance, he will wait for instructions. The fear of financial loss makes people obedient. The complexity of modern finance makes them ignorant. Together, these form the perfect architecture of quiet control. Governments learned long ago that force is loud and costly, but compliance is silent and cheap. So, instead of soldiers, they deploy economists. Instead of decrees, they publish policies. Instead of chains, they issue terms of service. When you compare the cycles, Rome's currency debasement, Spain's debt defaults, Britain's moratorium, America's 1933 seizure, Argentina's freeze, Greece's bail-in, you realize the pattern isn't financial at all, it's civilizational. Every great power eventually converts trust into debt and debt into control. It begins with prosperity, decays into policy, and ends with confiscation. Every citizen becomes a depositor, every depositor a creditor, every creditor a casualty of the next stabilization. And when the reckoning arrives, the system calls it a necessary adjustment. We are living inside that adjustment right now. The laws have been written. The infrastructure is in place. The narrative of digital stability is being seeded into public consciousness. The only thing missing is the spark, the next liquidity crisis, the next panic, the next too big to fail. And when it comes, it will not look like a collapse. It will look like an update. If history always warns us, why do we never listen? Because we prefer comfort to comprehension. Because we mistake access for ownership. Because we have forgotten that every empire ends when its citizens stop asking where their money actually is. The truth is not hidden, it is simply inconvenient. And so, as we move deeper into the 21st century, the ancient pattern continues its slow and silent return. The banking seizure pattern did not end with gold or paper. It did not end with coins or credit. It has evolved into something far more elegant and far more dangerous. For the first time in history, the seizure will not require a vault, a soldier, or even a signature. Only an algorithm. We live in the illusion of possession. We scroll through balances, swipe cards, and tap phones, all gestures of faith in a system we do not control. The screens glow, the numbers move, and we tell ourselves, this is wealth. But deep beneath the digital choreography lies a truth older than empire. Your money isn't yours. It's a claim, a belief, a signal of obedience to a structure built on credit and trust, and that structure is beginning to crack. The year is 2025. Around the world, trust in banks is quietly eroding again. Inflation, once called transitory, has calcified into a permanent scar on the global economy. Governments print money not to create prosperity, but to delay collapse. Each bailout, each subsidy, each stimulus package buys time. But time, like credit, always comes due. America's debt now exceeds $36 trillion. Interest payments alone outpace defense spending. The Treasury auctions debt that the Federal Reserve must purchase to keep the illusion alive. The result is an empire floating on self-borrowed air. Every dollar printed devalues every dollar saved. Every rescue creates the next crisis. And when the next reckoning arrives, as it always does, the banks will not ask permission. They will follow the law. A law most people never read. In 2023, the Federal Deposit Insurance Corporation held a series of closed-door meetings. The topic? How to handle systemic resolution events, the modern euphemism for a banking collapse. Buried within the transcripts is a sentence that defines the future. Depositors may face delays in access to funds during the resolution process. That phrase, delays in access, is the new word for freezing. It means what it always meant. Your money, in times of stress, is no longer your money. And when the FDIC's insurance fund, designed to protect $250,000 per account, holds barely 1% of the deposits it insures, what happens when the first domino falls? The answer is the 2025 Bail-in Plan, the quiet evolution of financial survival into financial servitude. Here's how it works. When a bank faces insolvency, regulators trigger a resolution. Instead of the government stepping in with taxpayer money, the old bailout, the bank converts part of its liabilities into equity. You, the depositor, are one of those liabilities. Your savings are restructured into shares in the failing bank, shares that can be sold, transferred, or redeemed until the crisis is over. By the time the bank stabilizes, your equity is worthless. The balance you see on your screen is still there, it just no longer represents cash. That is the modern art of confiscation. Nothing disappears, it simply transforms. In a system built on faith, changing definitions is more efficient than breaking locks. Central bank digital currencies, the new holy grail of finance, promise convenience, speed, and control. Every transaction recorded, every coin traceable, every payment programmable. But beneath the promise lies the perfect infrastructure for total financial control. Imagine a crisis, a bank run, a market crash. The central bank steps in, issuing emergency digital credits to stabilize liquidity. Funds are distributed instantly, but with conditions. You can spend them only on approved goods. You can't transfer them abroad. You can't withdraw them into cash because cash no longer exists. What you have is access, not ownership, permission, not possession. In the name of stability, money becomes software, and software can always be rewritten. The new rulers of finance aren't kings or emperors, they're algorithms. Markets are driven by code. Deposits are verified by code. Policy is executed through code. And when code replaces conscience, power becomes invisible. A modern bail-in won't look like a seizure. It will look like a technical error, a delay in processing, a glitch in compliance, and by the time the truth emerges, it will be too late. Because the decision will have been automated, executed by a system designed to obey laws that were written to protect banks, not people. The empire of marble temples has become an empire of servers. We like to believe that money is a medium of exchange, but in truth, it is a mirror of faith. When that faith breaks, the system collapses. Not because numbers change, but because belief evaporates. Every hyperinflation, every crash, every bank run has been a crisis of trust, disguised as a crisis of liquidity. And in 2025, that faith is eroding faster than ever. Surveys show that fewer than 10% of Americans fully trust their banks, 70% live paycheck to paycheck. 1/3 have less than $1,000 in savings. Yet the stock market breaks records, and corporate profits soar. This is not prosperity. It's a mirage powered by credit, a pyramid built on promises. The new system doesn't need to seize all your money. It only needs to control your behavior. Dynamic interest rates discourage saving. Inflation punishes patience. Negative yields make holding cash a liability. And soon, programmable currency will make choice optional. Want to move funds abroad? The app declines. Want to donate to a disapproved cause? The payment fails. Want to withdraw too much too fast? Security review in progress. Every restriction will be justified as safety. Every safety will become a chain. Freedom will not vanish in one act, it will dissolve transaction by transaction. Look at the world today and you will see the familiar prelude to collapse: rising inequality, masked by consumer debt, banks consolidating power under the banner of efficiency, laws rewritten to redefine property as privilege, nations discussing temporary restrictions on movement of capital, and yet the average citizen scrolls past these headlines as though reading about another planet. We think collapse happens elsewhere in fragile states, corrupt economies, broken regimes. But collapse is not an event, it is a process, and it has already begun. Every seizure requires consent, not explicit, but passive. The Romans accepted debased silver because the emperor said it was still money. The Americans surrendered their gold because the president said it was patriotic. The Cypriots accepted frozen accounts because the EU said it was temporary. And today, the world accepts surveillance currency because central banks say it's inclusive. We are being conditioned for the final stage of the banking seizure pattern, the phase where ownership becomes service and freedom becomes subscription. Your assets will be managed, your transactions will be verified, your savings will be protected. All words that mean the same thing. You no longer decide what happens when the entire global system depends on faith that no longer exists. You get the quietest collapse in history. Not a crash, but a controlled demolition. Central banks will continue printing. Governments will continue spending. Economists will continue explaining. And citizens will continue believing until they can't. There will be no single day of reckoning. No stock market apocalypse. No explosion of chaos. Instead, one morning you'll wake up and realize the rules have changed. Withdrawals require review. Transfers face approval. Your digital wallet displays a message. Funds temporarily inaccessible due to system stabilization. And you'll remember this moment, the one where history whispered but no one listened. When you strip away the complexity, every empire's end is the same. A loss of faith disguised as reform. Rome called it decree. Spain called it restructuring. America calls it liquidity management. But beneath the words, it's the same ancient ritual. The powerful taking what remains of the people's belief to fuel one last illusion of control. Every empire believes it can print its way out until the ink runs dry. And when it does, the paper turns to dust and the digits turn to silence. That silence is already growing louder. There's a moment at the end of every collapse, quiet, fragile, and almost sacred, when the noise fades and truth re-enters the room. It is the moment after illusion dies. After the numbers vanish, after the empire finally stops pretending that silence is not the end, it is the clearing where something new can begin. Every civilization that lost its wealth also rediscovered its wisdom, and every citizen who lost their savings found painfully what real value was always made of skill, awareness, and resilience. The first lie of modern finance is that wealth lives in institutions, that banks hold your future, that policy can guarantee prosperity. But wealth has never been numbers, it has always been capacity. When Rome collapsed, the merchants who survived weren't the ones with the largest accounts. They were the ones who understood exchange. They could barter, build, and adapt. They remembered that value was a human invention, not an imperial decree. When Argentina's banks froze in 2001, those who endured weren't the richest, they were the most resourceful. Neighborhoods created barter clubs. Skills became currency. Communities traded tools, knowledge, and labor. The lesson repeats: when systems fail, people replace them. Your wealth is not in your balance. It's in your ability to create, to move, to connect, and to understand. Every empire centralizes before it falls. Rome centralized trade. Britain centralized credit. America centralized finance. Centralization is efficiency on the way up and catastrophe on the way down. To survive the banking seizure pattern, you must think like the merchants who lived between empires, flexible, local, and sovereign. Hold multiple forms of value. Diversify beyond the digital-owned skills, not just assets. Because in a world where everything can be frozen, the only true wealth is what can't be seized: knowledge, trust, and tangible utility. Diversify your holdings not just across banks, but across systems: gold, land, tools, business equity, and networks of real human exchange. Digital convenience has blinded us to physical resilience. But when the screen freezes, it's the tangible that keeps you alive. The greatest tool of control has never been force. It's been language. Bail-in, resolution authority, financial stability mechanism. Each phrase sounds benign, even benevolent, but they all mean one thing: the transfer of power upward. Learn to read between the words. Follow legislation, not headlines. Pay attention to the documents. No one else reads the white papers, the resolutions, the implementation frameworks. The next confiscation won't be announced. It will be encoded in the fine print of stability measures. In every age, awareness has been the first line of resistance. In the 1930s, it meant holding gold when everyone surrendered it. In 2008, it meant understanding leverage before it imploded. In 2025, it means knowing what your money legally is and where it actually lives. The survivors of every financial collapse didn't wait for permission. They built alternatives early. During the fall of Rome, trade continued through local cooperatives and family networks long after the empire's currency failed. During the Soviet collapse, underground markets, black networks, kept millions alive. In Greece, after the Bailin, local digital currencies and barter markets quietly emerged across the islands. When the system becomes a cage, new systems become the exits. Today, that means small businesses that operate outside centralized platforms. It means communities that trade locally. It means digital and physical networks built on trust, not policy. You don't need to escape the system overnight. You only need to weaken its grip on your survival. Resilience begins where dependency ends. The banking seizure pattern will repeat of that. History is certain. But individual collapse is not inevitable. Empires fall, but people endure. Systems seize, but human creativity breaks through. The key is to understand that history doesn't demand repetition, it only demands awareness. If you see the pattern early, you can step aside. If you accept it blindly, it will consume you. Prepare, not in panic, but in principle. Withdraw from the illusions of control and reinvest in the realities of life. Because in every cycle of ruin, those who survive aren't the loudest or richest. They're the quiet builders, the observers, the ones who refuse to trade their awareness for comfort. The collapse of trust is not just a financial event, it's a psychological cleansing. When the symbols of wealth lose meaning, the soul of a civilization faces itself. We are forced to ask, what remains when the screen goes dark? The answer has always been the same: character, community, and creation. Money is the shadow of value, not its source. And when the shadow fades, the light that remains is the truth of what you are still able to do, build, and give. True rebellion in the modern age is not chaos, it's sovereignty. Grow something, loan something, own something that can't be switched off. Refuse the dependency that turns citizens into customers and savings into subscriptions. The world will tell you that freedom is old-fashioned, that decentralization is risky, that questioning the system is cynical. But those are the same lies every collapsing empire has told its people right before taking everything they had left. This time, you do not have to play along. Someday, years from now, people will look back on this era the way we look at every empire before, with disbelief. How could they not see it coming? They'll ask, how did they let it happen again? And the answer will be what it's always been. Because it didn't happen all at once. Because control came softly. Because the vault door closed one click at a time. But for those who saw, for those who listened, the ending will not be loss, but clarity. The ones who understood the pattern will rebuild before the rest awaken. They will form the foundations of whatever comes next. And maybe, just maybe, they'll tell the next generation, never again give your freedom to a balance sheet. If this opened your eyes, subscribe. History isn't repeating, it's warning. And if you believe these stories deserve to be told, please like and share. It helps me keep doing this full time.